Look, thank you, Gordy and Dave. Those are great presentations. The observant amongst you will have noticed that the slide showing the operating cash flow, those lovely meaty operating cash flows, out to the side was some steak. And you'll also notice that the underlying profit growth slide out to the side was some desserts, some sweet foods. So those are examples of the sorts of meals that our residents are now having. So look, I'd like to open the session up for questions from the floor, and then following that we'll take questions from any callers who are on the conference line. We'll bring a microphone round to you with those with a question in the room so that you're heard, as I said at the beginning, and so that people on the webcast can hear you clearly. For those of you listening on the phone conference, the operator will advise you when you can ask a question. So let's have some questions, please.
Thanks. Just first one on the aged care business, if I may. At the AGM, you flagged an increase in nurse wages, and no doubt well deserved. Just interested in your thoughts, though, on if you can provide some comments on the profitability of the aged care business and whether the sort of large-scale facilities that Ryman's been building, the 120 unit facilities, are still warranted given the funding environment in New Zealand, particularly compared to what you can return in Australia?
We're very committed to them, Stephen, because in our opinion, a 120 care bed facility is very appropriate for a village where there might be, say, 200 or more independent living residents. And in addition to that, we're also committed to our service department and assisted living offering as well, where we'd typically be looking to build anywhere from 60 to 80 of those at a village in a typical sort of configuration. So we still very much absolutely focus on doing approximately about 50% of our build as care related and 50% as independent related. And the reason for that is that although people are living longer, they are also living frailer. And we're seeing medically more, it's called sort of a greater compression of some of the comorbidities towards the end of people's lives. And so it's absolutely vital at that time when people really do need quite intensive assistance with their life and medications and everything, that villages are able to cater for that and deliver on the promise of a continuum of care. So when we look at the profitability of the care business, it's obviously enhanced for us because we do run at 97% occupancy, and it is also enhanced by the fact that we receive room premiums for the majority of our rooms. We do have people come in and don't pay a room premium. That's okay, but we tend to target getting a room premium for all the rooms that we build. So that actually means that our care business is profitable. If it purely stood on its own, you'd maybe look at it and wonder about the return on equity. And so I'm not going to go into the numbers on that. But I and the board actually don't do that for a really simple reason, that if you think about the villages you have visited, Stephen, there's no sort of segregation, there's no Berlin Wall between one part and another. The villages truly are a seamless, integrated being and community. And I see that the care business drives as much the retirement village earnings as vice versa. I cannot, in my mind, separate them. And that's why we do that is why we don't do segment reporting under international standards, because we genuinely don't look at the business that way. That's why we focus on an overall underlying profit, because all parts contribute.
Okay, thanks. And then just maybe one on the guidance range, 23 to 238. Able to give us a bit of a flavour as to what would need to happen to get to the top end of the range, and perhaps also the bottom, and any comments you can make on allowance within that range for performance in Melbourne, which has been quite topical, that the housing market has been a little bit under pressure, particularly in the last quarter. So any comments on that would be helpful. Thanks.
Yeah, so it's more around the new sales and resales of retirement village units. It's not really around any care sensitivity, if you like, nor DMF. So when we look at it, we take a view that we get about 80 units come up for resale a month. But if you had 2 or 3 months where it was a lot less than that, or a lot more than that, that actually could materially, you could have millions one way or the other, given the margin associated with each unit now. So that adds a degree of variability, Stephen. And the other thing is that we could sell more actually at some of our villages between now and the end of March than what we're planning is possible, and is what the sales are targeting. So that reflects the higher end of the range, and the lower end of the range probably just reflects more of a disappointment of how many vacancies we get on resales, which we don't know about yet, and perhaps any sort of softer sales in any of our villages we were able to book.
Great. Thanks for that, Gordy. And just one last one from me. You able to provide any approximate indications of where net debt might end up at the end of the year, given your visibility on the investment plans and expected cash flow recycling? Thank you.
We just don't tend to forecast debt, but I guess the helpful comment from Dave earlier on was that we've got 50 mil coming in the next 2 weeks, and we will continue to be cashing up sites quite well, I think, over the next few months. Yeah, and Stephen, one of the things about the first half result, which I thought was really good when I went through it with the team one afternoon a couple of weeks ago, was the operating cash flow increase, actually. Seeing that come in at over 24% on the back of a really strong last couple of months sales-wise, so they're obviously always going to be debtors. It was great to see that strong operating cash flow performance. And if you couple that with the record amount of pre-sales of 214 million, when I was sort of looking at our historical statistics yesterday, actually, in the 2016 financial year, in the whole of 2016, our new sale value was 222 mil. So it's sort of it's amazing how time moves on, that we're sitting here with pre-sales that would have represented an entire year's activities only 2 years ago.
I think it's worth repeating also that our bank debt, 80% of that is purely designated for the development that we're undertaking at the moment. So what happens to the bank debt will be determined by what development we're undertaking. And the actual core debt is relatively small for a company of this size with a balance sheet such as we have.
Which doesn't give me the opportunity to give another statistic, which I was hoping to get out, which is we hit over 10,000 beds and units in our portfolio in September. We got to just over 10,000, so that was quite a milestone for the company, actually. And our land bank hit 6,000 too. Yeah. So when you think about the fact the land bank has to be funded, and a lot of it is also in progress, and it's taken us 34 years to get to 10,000, and the land bank 6,000, you can see why there's some debt to fund that.
We didn't script that answer, Stephen.
I've just been dying. As soon as I saw it hit 10,000, I just missed it.
I'll kick off on debt too. Good morning. So I think, David, you mentioned the facility's been increased to 1.5 billion, which I guess gives you almost 300 million headroom again. I guess just in terms of the syndicate's 5, I mean, as the debt keeps getting bigger, given your growth ambitions, what's your sort of approach going to be to sort of diversity of funding, and I guess potentially duration as well? And just one other thing on debt, I think at the full year you were at around 11 or 12% interest rate hedging, which has obviously been very beneficial for you over the last few years, that low hedging position. Can you just sort of comment on where you are at the half year, and what the outlook is for interest rate cover for the business if you are increasing it?
Yeah, so I guess in terms of the 5 banks, but as we mentioned, we've got 5 very supportive banks that were all willing to participate in the increase.
In fact, they're oversubscribed.
Yeah, oversubscribed on that. Yeah. And there are other parties we could to, and we do talk to, but there's also the option of a retail bond that we will consider potentially in due course. But at the moment, we're very happy with the banking partners we have and the relationship we have with them and the support they've given us.
What was the total oversubscription?
There's about another 25 mil, I think it was.
Plus the other bank.
Plus the other bank that
so
was willing to come in, so about 250 odd mil we could have.
Above. Yeah. So, and the reason for that, Ari, is that when banks look at us from a funding point of view, they can see that we've got an enormous healthcare business supporting a highly specialised asset class that is driven by need, and which has sort of got the fundamentals of residential housing behind it, but with basically like a 50% deposit underpinning it too. So, if they think about repayment, the majority of the debt is working capital debt. It's the land bank and it's the work in progress at places like the slides you saw at Narraneck and Tropicana, and when people move in, that will be paid for. So they can see that part of if that's total debt, that part of the debt will just go like that if we were to stop development. So that's repayment ticked for banks, which they like. And then there might be, say, 100 or 150 million of sort of core debt where we've done stuff at villages to keep them refurbished and what have you, projects. And given our significant earnings, the ability to service any level of debt, even the full debt, is very straightforward, even just with our recurring income. So even if we made no development earnings at all, our covenants would still cover us on just purely on a recurring income basis. So serviceability is comfortably covered, and so is repayment.
Plus we've got the resale bank of 855 mil and accrued DMF of about 350 mil. So there's another 1.2 of pent up sort of cash in the established part of the business as well.
Yeah, but look, we're obsessed about recycling capital. Don't get me wrong. Like that is the business model of Ryman, and we just have to have times where if we're building up the land bank, say in Melbourne, we've had to sort of accept the fact, I guess, that we'll just have slightly higher debt while we're doing that.
And on the hedging, we're at the similar levels to what we were at year end. We haven't changed our approach to that in the half. And look, we'll continue to monitor that, but as you say, we've benefited from that, and it still annoys me that they're always out of the money. So
there's still a fair value loss on the face of that balance sheet for about the last 5 years, not because of swaps.
Well, they can change quickly when they do.
Well, I know.
I guess moving to the other bit that sort of interested me and was sort of the theme of a couple of questions I had. David, I guess like you and the business, I'm sort of trying to look at it from the four segments. I guess you mentioned care provision, property development, property maintenance, and a real estate business. But it's not always easy to sort of, from a forecasting perspective, put all that together. I won't go over care again because Reggie's already had a go at that. But just in terms of, I guess, the real estate sales business, I mean, you guys touched on it a lot through the presentation, and it's a huge part of what you guys are. Sales and marketing expenses, in terms of both over the resales engine and then what you do on the development side and all the work you do in the brand and that sort of stuff. What sort of orders of magnitude are you investing in the sales engine and the brand in this business, and how much of it's capitalised and how much of it's expensed?
None of it's capitalised, and we don't really run around disclosing it, to be honest, because I wouldn't want to provide a benchmark for competitors. But it's millions.
Yeah, well, I'm sure it is. Yeah,
it's millions.
Tens probably.
No, it's not tens. No, it's not tens of millions.
Okay, and then just in terms of the resale margin, which you disclose as gross, obviously, I think your portfolio has significant differences to some of the other operators in composition, including Met. I mean, in terms of the amount you spend on refurbishment, some of the investment you do around the villages, which you do on a rolling basis, as I think you referred to there,
yeah.
What sort of percentage of resales turnover revenue is that each year off the gross margin?
I don't know that we calculated it in that way. In fact, in the back of your information pack it identifies line by line the refurb costs and what we invest in refurbs. We don't really see it in that line. as I said in the presentation, it's much more about meeting the expectation of the resident and the promise that Ryman has. So we'll do whatever is required. And in fact, at Malvina Major, it was quite a major refurbishment, partly because of the earthquakes, but partly also that it just really didn't match the promise that we make to people.
Yeah,
I understand that it's important.
I mean, you're probably looking at about, for an individual village, you could be in the region of 4 to 5 million to do like a 15-year refurb of the common facilities and the community centre, the kitchen, that sort of thing. Yeah. Then for a service department, each time there's a resident, move between each time. It really depends on the tenure, but on a typical basis, first time round, there might be things like new drapes, sari, but it might be some time actually before things like kitchens need to be replaced. That might not be for 10, 15 years, and same for independent living units. So because we do all of our construction in-house, all of our buying in-house, I think when I looked at it last a while ago, for an independent unit you might be looking at sort of 5 to 10,000 the first time round, and maybe second time round anywhere from 15 to 25,000, depending on what work needs to be done for the for the kitchen and the bathrooms, and new drapes and carpet at 15 as well, 15 years.
Sure, and then just closing out on this, so the village capex that you disclose separate to the project or the care systems, that would comprise, maybe $10 million a year on upgrade if you're doing a couple of villages a year, and then there'd be the refurbishment in there as well. Yeah. And what would be the sort of the split between investing back in the care, which is PP&E investment, I guess, and the IP investment, the refurbs?
Yeah, probably. Yeah, but I think Dave will probably come back to you.
Yeah,
we can work that out.
Yeah, we can work that out.
Okay, cool. Thanks. That's all from me.
Good.
Jeremy Simpson
Yes.
at Forsyth Bar. Well done on a good result, guys, and great to see the momentum continuing across all parts of the business. I'm interested in the high-level feedback you got from Sterling and just what they think of what we're doing with regard to the concerns around looking after people with dementia in New Zealand. And then also just a bit on, in terms of the pipeline, interested in some thoughts on what your sort of thoughts are around Karori, given the size of the opportunity there, and you had a bit of an unfun fight at Devonport for a while, and where there's learnings from that, and what anything you can say around that.
Perhaps David, as someone who's actually got medical knowledge, could answer the Sterling, the Sterling question.
So Sterling obviously had not met with us before, and they were not familiar with the fully integrated village that we run. Their experience was much more with special care units or dementia care facilities. So they were fascinated at how we manage to provide the full continuum of care. I think it's fair to say that they were impressed at what we offer, but they had lots of really great little ideas about how to improve. I would say the small detail that to us is small detail, but to a person with dementia or cognitive impairment is important. At the safety day, one of the things we did was we had a virtual reality set of headset that you put on, which gave you the impression of being cognitively impaired, and such simple things as the clear definition of colour between the carpet and the wall, so that a person could sense when they were near the edge of the room and stuff like that. So all of that was really brought to life to me, some of those critical sort of things. And so it's at that level that they were able to make really constructive comments.
And Karori. Yeah, look, I've known the Karori suburb for probably, I'm based in Christchurch, but my dad grew up in Wellington, and my dad's brother Ken and his wife Judy, they lived in Karori for about 45 years. So I've been to Karori a lot, so I know it's a very special place. There's the difficulty has been that a lot of locals weren't happy about the fact that the university sold that site to us, but obviously that's got nothing to do with us. That's just a sort of I guess it's more of a political thing. But anyway, that's happened now, and we move on. So what we've done is we've had lots of drop-in days with the community. There's a number of interest groups there, Jeremy, who have given us their full and frank views on a whole bunch of stuff around how they'd like to see it developed, things that they are concerned about. And so what we do is we just take all of those into account, and we have to sort of sit down and think about how can we make it work. One thing that we are doing is we're working with a heritage architect, because there is potential at that site to retain some of the older buildings where there's real historic and cultural significance to events that happen there, and with some of the Brutalist architecture, where some of the site maybe will be integrated in with the village. And what we need to do is we will be talking through more detailed plans with people like the Historic Places Trust and the community over the next sort of couple of months as well. So they're never easy when you've got to work with the community hard, but look, we want to build a village that just looks great, and there's real interesting architectural opportunities there, and I know from my family connections that it's an excellent site for the village, and it will be in very, very strong demand there because there is very limited offering, and that is a very large suburb, and so we will end up with a very successful village in Karori.
There's a definite shortage of retirement village units and care beds in that area. But I think one of the challenges has been that the community has used the facility itself, and so we're keen to try and continue that opportunity for the community. And so that's where we're sort of listening acutely to see how we can help make that happen.
Is that in regard to sports amenities?
Yeah, things like dance halls and performance halls, netball courts, there's a whole ton of stuff.
Market days.
But you have to stand back and look at what you can work on site, maybe what you can do off site. So we're really committed to try and make it work because we want it to be something that people feel good about.
Thanks for that.
Yeah.
And just lastly from me, resales pricing looked a little softer than I was expecting. Can you give some feedback on what's happening on pricing generally for like, if you like, on village by village basis?
So like the pricing hasn't changed. It's actually probably gone up since the end of the year. What you're seeing though is just a bit of a mix of what has actually come up. So the units coming up have been, I guess, at our more regional sites and villages. So that's pulled the pricing back. So that's why it's hard to sort of look at it at that granular level.
Yeah, pricing is up.
Yeah.
Yeah, but the mix can be quite significant because you get a few at some of our some of the higher end villages, and can affect the sort of weighted average price quite a lot. Yeah.
Thanks. That's all for me. Thanks.
Yeah.
Thanks, Jeremy.
Marcus.
Three questions for me. I just wonder if you could talk a little bit about the competitive dynamic in New Zealand at the moment. I suppose some of your peers talking about higher inventory levels. Some of their villages are hard to sell. I suppose the other thing I note is your comments around care profitability, smaller players going out of the markets, obviously different messages from different people. I just wondered if you could give some views on how you see the market at the moment in New Zealand.
Yeah. Okay, so from a peer point of view, I mean, we just absolutely don't comment on competitors. We're very respectful of what people do. From our perspective, what are we seeing? I guess the best summary of it is in the actual results, really, which is we have got incredibly high pre-sales. We've got resale stock at the same level we've had for the last 5 years at 1.2%, which has been our average for the last 5 years of the portfolio. Care occupancy is 97%. We've had strong operating cash flows. So the basic metrics that we look at to see whether we're performing in the market are healthy and good. And look, I don't actually follow too much what competitors' view on those sort of things is. I did read one in Australia last week which talked about sales being off, sounded pretty significant actually, like 38% or something. And that may be a legacy issue they have with some of the media commentary they had a year before that.
I'd just add, Marcus, that in terms of the care, one has to remember that we've been in this business for 30 years and invested very heavily in acquiring the IP, and you can see from the presentations that we continue to invest in both skill and quality of care provision, and that's not easy to duplicate. It's not an easy market to be in, and people's expectations increase year on year. So it is challenging for other operators.
I spend I probably would go to a village every week, and one of the things I do is always have lunch with our service department residents, or afternoon tea with independent residents and stuff like that, and obviously a bit of social chit chat. But I really like to find out why they bought, particularly people that have bought in the last sort of 12 months, and all the things that are really important for people are the full continuity of care.
Yeah.
I have met a number of people, every single village, where either the husband or someone's wife, unfortunately, is in the dementia unit. Okay, so and people, our average age of entry for independent is 78.5 years old, and I just find people are more, I guess some people, you can be quite pragmatic at that stage of your life, that there may be health changes ahead for you. So that full continuum of care is hugely important for people. And you know that our villages are 50% care related, and that's a big deal. The other thing that people, I think, are, and society is becoming more conscious of fairness. And so that the Ryman difference, which is the lowest DMF in the sector at 20%, fixed weekly fee for life, don't charge any fees when you vacate the unit, and all that sort of stuff, is more widely known than maybe even we think when we speak to people. And it's a very important part of the bargain of trust that we form. So perhaps that's the context for the fact that the overall metrics we've talked about today are in reasonable shape.
Secondly, can you talk a little bit about why you're so confident in 5 villages in Australia? Clearly the progress has been slower than you would have thought.
Yeah.
What gives you the confidence? 5 by 2020 just seems a long way away from just opening the second and end of 2018.
That's fair enough, Marcus. So we probably should clarify, 2020 I would regard that as New Year's Eve on 2020. Not New Year's Day, no. So maybe one resident, sleeping in a
Not good,
in a place. I'll be the village manager. So look, it was a big time between the first and second village, Marcus, and that was frustrating for us, and I know it was frustrating for shareholders. And I think that what we do is we learn a lot during they're the sort of times that you learn the most, probably, when you get frustrated and you think, we should have resourced up a bit more, or maybe we should have tackled that issue in a different way. But Brandon Park is a very large-scale village, and it was a tremendous achievement to get that approved and now to get that open. And I think that if we've got 2 villages, so if you think about, how do you get 5 sites open? First of all, you've got to buy them. So now we've got 9, and they're great. And you can see from the map of Melbourne, they're quite cleverly all around the border of Melbourne. They're in different clusters. We won't have. They're not all big metro, big intensive apartment style villages. There's a mix. So you've got to buy the land. Then you've got to get them consented. So we've had 2 consented now through that, and 4 consented now. Burwood, Coburg, Wherry Dunlop, and Brandon Park. So we need 1 more to get our 5th. We were hoping that we would have heard from Geelong this month, actually, but the meeting with council's been deferred to December the 18th. Ocean Grove, though, already has a development approval for a retirement village and aged care facility, so we'll hopefully move quickly on that. And Aberfeldy's, our preliminary discussions with local council and so on has been really positive. So just to give you a bit of a flavour, we've got some good development approval progress happening, with 3 being submitted. Then you've got to start building them. So 1 built, 1 open. Coburg and Burwood East, I hope that we're building there in the next sort of 2 to 3 months. There are various pre-start conditions at councils that just take time. So we've been doing things at Burwood, for example, where we've been discussing some refinements to the urban design, look and feel of the village, and that's good because it will actually give it a better long-term outcome. So by the end of March, hopefully we'll be building at 3 sites. And then ideally, in the next by say this time next year, we might be building at Geelong as well. We might be building at Ocean Grove. We might be starting to look at Aberfeldy. So there's just a number of points of momentum where, if I would go back, and I remember sitting in these meetings 2 or 3 years ago, it was all just a question about where's Brandon Park at. But what you're hearing is we've got a lot more irons in the fire now, and that's what gives us confidence about that. And for me, at a certain point in time, we'll be looking well beyond 2020. We're committed to the Victorian market. We want to get a roll on there. We want to match the New Zealand build rate there. And I think to have developed a really wonderful portfolio of sites there, we're on the way.
I think, Marcus, the impatience was shared at the board level as well. We were very aware of that gap. But one has to remember that the Brandon Park on Dame Nellie Melba Village is actually the size of Edmund Hillary. It is a really big village. And I think that we learnt a lot from the first village, and we then have had to spend some time building some strength. And you heard Gordy talk about the increase in the number of people in design, and that takes time to get the right people. And we've been building in New Zealand, like we built Weary Dunlop largely out of New Zealand. Now we're actually building our team in Australia, which will enable us to go with much greater speed. So I feel confident. They keep telling us we're going to have 5 by 2020. We promised 5 by 2020, so we will do it. But I think Gordy's point that we do actually have a much longer term horizon that we're aiming at than that particular number.
And then just finally, with the residential house turning down in Australia, could you talk a little bit about, and I know you're obviously just selling one village at the moment, so the experience around selling that relative to a housing downturn may be pretty limited. But on the flip side, is it opening opportunities to be more aggressive on land purchases at better prices?
Yes to the second question. Yeah. So we'll be our usual fussy sells though. They have to be great locations. In relation to, if you want to bring up the slide people, on the median house price one, it's got the 2 nice ladies with the golf clubs looking at it. Anyway, while they bring that up, the most important thing, I think, Marcus, in a market where there is price risk, is that there's great affordability for people, and that the shape of the village that you're building is driven strongly off needs. If we were building a lifestyle village, I believe that they may struggle, because you may decide, if you're sitting in the paper, reading the paper every day, incredibly, is another story, basically a photocopy of the last story of the previous day, which is that the housing market's got a problem. And that can put people off, and if they actually fit in well and they don't need to move, what happens is they don't move. What we found during the GFC, which was where housing transactions in New Zealand dropped by 2/3, prices dropped by 10%, days to sell doubled from 30 to 60, and that all happened in 6 months, was that the stuff of life continued. So people who are needing to come into care, people who are needing to come into service departments, who are typically about 86 or 87, and you can see from that graph, incredibly affordable in any sort of market, that sort of stuff happens. So you're left just really talking about what's the risk with independent. So independent are about 50% of our portfolio, and the average age of entry is 78.5, so it's the older elderly. When you speak to people about their story of why they came to the village one-on-one, it's usually some sort of life event or health-related story, to be honest. And even in a market like Melbourne, David Bennett mentioned that the house prices would have to drop 34% before someone wasn't freeing up additional capital. It would still be affordable, ironically, and in Auckland, 20%. So we like the fact there's good headroom, there's plenty of affordability, and there's a compelling offering for people with really fair terms and good service.
And as you said earlier, it's a needs-based decision. It's not a lifestyle decision. So the last few dollars in the house price are not what's critical to the person selling their home.
And on that slide, the lower price point or cost for you in Melbourne versus Auckland, does that continue as the villages roll out?
It may not. No, it may not. Auckland's got a number of key villages in there, which some of them are quite high. Some of them are a bit higher priced.
Yeah, and as a village matures, we get close to the local sort of median house price. But on the first sale down, we are typically a bit more of a discount. And so that chart reflects that in Auckland there's a lot more mature villages than there are in Melbourne.
It was a great time to buy in Melbourne if you're a resident. If you thought the prices were coming down, now it's good.
Yeah, fixed weekly fee.
Any other questions in the room? Are there any questions from people calling in?
Please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. And if you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Jason Hamilton from Accident Compensation Corporation. Please go ahead.
Morning, guys.
Hi, Jason.
Oh, it's nice and clear. Hello.
I've got three. I guess first one's a comment. As a Karori resident, I'm pretty interested in what you're going to do with the village.
Another interest group.
Secondly, just a question. Can you just give some CapEx guidance for the full year?
We don't. We actually haven't tended to, I have to say, Jason.
Why is that?
We've given profit guidance and build guidance. We just haven't given CapEx guidance.
I know how much you're going to spend on them, but...
We just haven't given CapEx guidance in the past because I think that the overall parameters we give guidance on are people have tended to be able to work with those parameters for a long time.
Okay. Just there's a massive variance out there in the analyst community around what you might spend on CapEx, so it'd be good to get some guidance. Secondly, can you just talk to how many sales and resales actually settled in the first half?
Not off the top of our heads, no. And we don't actually give that. We've never actually disclosed that data. The data we have disclosed is the build rate and the sales rate. So probably the closest proxy to perhaps what you're thinking about, Jason, is that when I looked at it yesterday, in the last 18 months, we've built 650 beds in retirement village units. So let's forget about the beds. And in that same period, we've done sales of, I think, 626. So they're pretty much matched. There's obviously some stock, as there usually is, around completed completed service departments where they can take about 18 months to sell down after completion, simply because you're dealing with 86, 87-year-olds and there's only a certain amount of people with that need in the community at any one time.
Okay. Can I ask the question a slightly different way? Can you talk to the receivable balance, and I guess how many units are related to as at 31 March, and how many units are related to as at 30 September?
No. Honestly, Jason, we just don't track it like that. I mean, we've obviously got detailed cash flow stuff that we manage the business on, but I don't look at the number of units in our debtors at March and September.
Okay, all right, that's for me.
Thanks, Jason. Is there another question?
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced.
Might take that as a no. Great. Look, thank you to everyone for coming and joining us. As you've identified, we've had a very good first half, great momentum, and great progress in the way we deliver care, and so now we can just have some informal discussion. So thank you very much.